especially from the FII perspective. Nitin Jain, Principal Fund Manager at Kotak Mahindra UK, joins us on the show. You interact with a lot of foreign investors, Mr. Jain. What is the consensus which you are drawing after your conversations with them regarding India, especially in light of how the environment has been post-budget?
Okay, pre-budget we were cautiously optimistic on India. Post-budget, while our optimism remains, but it has been moderated a bit down. I think the momentum of the last 6 months on the reform policy, we were hoping that it will be carried forward in a slightly more aggressive fashion in the budget. So there has been a little bit of tone down on that front. So we're still optimistic, but toned down a bit.
Right, but we've seen more than almost $8 billion of flows in Jan-Feb. You think that kind of momentum on FII flows can continue? Are you seeing interest still from you investors?
Okay, from a global flow perspective, clearly the world is searching for yields, the world is searching for returns. Global liquidity is still very ample despite the recent turbulence, noises from the US Fed. I think the concerns on that side are overplayed. We know global liquidity will remain benign for at least for coming 18 months, 24 months. So in that context, global flows should remain strong. But I think we should also need to caution that these global flows have been countered by domestic selling to a large extent. While you have $8 billion coming from the FIIs, close to around $5.5 billion has been sold by domestic funds and domestic mutual funds. Plus, there has been offer for sales by a lot of Indian companies and government disinvestment program. So a lot of it has got absorbed in the market by these kind of sales. So I think this flow is very important from India from a near term to a medium term to a longer term perspective, and we expect flows to continue.
But post the finance minister's attempt to consolidate the fiscal deficit, a lot of people say that the ball is now in the RBI's court. Do you expect RBI to ease rates further?
I think so. We expect the RBI to cut in the March policy also, and going forward we do expect a rate cut of close to 75 basis points for the rest of the fiscal year. We could be surprised on the upside. We could possibly have a higher cut by RBI through the year. Now I think the fiscal, just want to make a point there, the fiscal deficit reduction is actually a very positive thing from a longer term perspective. I recall last year when the finance minister gave a number of 5.3%, the street was close to 5.7%, and the actual number is going to be close to now 5.3, 5.2%. At 4.8, while we also doubt that 4.8 number, but I think it is going to be significantly lower than what we began with in April 2012, looking at March 2014. So in that sense, it has been a significant reduction. In our guess, RBI should follow it up by rate cuts to the tune of 75 basis points for the rest of the year.
Fair enough. What about investment opportunities then? Where is it that you have your sector preference in India? Are you overweight defenses, or is the focus on risk and beta stocks? We are overweight defensive. So if my biggest worry is current account deficit, so I am clearly overweight a combination of pharma and IT. We are underweight a little on the high beta names, particularly infrastructure and capital good. We are underweight there. Our beta play in our portfolios is clearly through banking, and that's our preferred beta play at this point of time. So we are more defensive than we were possibly 3-4 years back, but this defensive portfolio has been carried for the last 2 years now.
But what exactly are you looking for among financials? Do you prefer private sector banks, or PSUs are your favorite pick?
We have had a clear preference to private sector banks, and that preference stays. And there is no reason at this point of time to change our preference. That said, there is a valuation gap which is now emerging in PSU banks. So we are actively scanning that space. But there is no compelling reason to move our bias from private banks to PSU banks at this point of time.